to CNBC TV18. You're watching Markets Today, the show where we track 6 hours of the day's trading action in 5 headlines, and what a day it was for the bulls. I'm Sonia Shenoy, and these are all the top headlines that we're tracking for today. The bulls bounce back on the Lao Street. Sensex gains over 1,500 points. The Nifty gains over 400 points. All sectoral indices and all Nifty stocks end in the green. The rupee gains more than 50 paise against the dollar. Experts and analysts see the O2C capex as a big bet on the India growth story and see this along with the 5G rollout, the green initiatives and the big retail expansion driving growth and delivering returns to shareholders. And Narayana Rudalya tells CNBC TV18 it will look at building and buying hospitals to add capacity, even as KIMS closes a deal for the Nagpur hospital. Analysts turn positive on the sector and negative on pharma. And consumer durable players tell CNBC TV18 the Independence Day week was the best for sales in many years, and the outlook is upbeat for the festive season driven by the premium segment, but the mass segment remains weak. And a JP Morgan report says disbursements have picked up for auto financiers as pent-up demand returns after 4 years. Ashok Leyland rallies 4% after it launches 2 new variants of its popular LCV range, Bada Dost. And here's the lineup of what we have in store for you today. It's a packed show. In Market Opinion, we have Sanjeev Prasad, Managing Director of Kotak Institutional Equities. In Corporate Voices, we have Rajat Gupta of Ashok Leyland. All right, but what a day it was on Dalal Street. The bulls bounced back, and how? Yesterday there was a sell-off, but today the bulls took it away in style. The Sensex gained over 1,500 points. The Nifty gained more than 300 points thanks to a strong global sentiment. All sectoral indices ended in the green today, and all the 50 Nifty stocks posted gains for the day. In fact, the Bajaj twins, the auto stocks, Reliance Industries, Ashok Leyland were really the big gainers today. Anuj is here with the day's market wrap. Anuj.
Stunning day for the market. Nobody could have thought that, we will do this kind of market action today. The SGX Nifty was indicating that we'll have a gap up. But the market opened much better than that and then kept building pace through the day. There was not a single intraday dip today. The Nifty was up over 2.5%. The Bank Nifty was up nearly 3.5%. And most of this was domestic in nature because globally there was no signal of something like this from either the US market futures or the Asian markets. The broader market has been very strong. So the big question is the start of something big? We'll find out. Quickly, let me run through the big gainers. Across the board, there were gainers, but financials stood out, whether it was names like Bajaj Finserv, Bajaj Finance, or IndusInd Bank. But the real impetus came from the big ones, SBI, Kotak, the HDFC twins, ICICI Bank, and of course, others as well. On the gaining side, some of the other names which did well, Tech Mahindra, the Tata Group stocks, Tata Motors, Tata Steel, Titan, Maruti did well, Larsen did well, Infosys did well. As I said, today it was, almost like hitting a dart and, throwing a dart and it would hit a winner. The big question is this start of something big? We'll find out.
All right, Anuj, thanks a lot for that. So the bulls started the festive season in style. Let's get you some expert opinion now. Rana Gupta, who is a senior portfolio manager and India equity specialist at Manulife Investment Management, said that the US interest rates cannot be ignored in a globalized world. He also adds that he remains positive on India in the long run. Listen in.
In this globalized world, we cannot ignore the US interest rates. This kind of outlook where the rates are getting higher, not just US Fed, but other central bankers becoming more hawkish, geopolitical scenario uncertain, and also, there is this increasing risk of, inflation and all of it. Around this time, to get into the stock market, you need supportive valuation. Coming to India, the top line growth will be good. So even with margins lower than expected, the absolute profit delivered is still good. So earning cuts will be lower. I think the longer term India, positive argument that we have been talking about for a long time now, led by digital economy, manufacturing, and now increasingly we are seeing pace of infrastructure improvement and all of it, that stays.
Okay, that's the word coming in from Manulife. In more opinions, Sanjeev Prasad of Kotak Institutional Equities says that the valuations on financials and banks are more reasonable than other stocks in the Indian market. He also discussed his outlook for the auto sector. Take a look.
Again, financials is something where valuations have been more reasonable compared to other growth quality stocks in the market. You look at HDFC Bank after the merger with HDFC, again, adjusted for the value of its investment in various subsidiaries, It is available about 2.2 times FY 24 basis. So I think banks, at least the tier 1 banks, still have reasonable scope for re-rating. Actually, we are somewhat negative on the auto space. More on the OEMs, I would say, we're pretty okay on the component range. If you look at the financial returns which the incumbents make, that is very, very high. So I think this is a sector which is ripe for disruption. Growth is slowing down. So I don't know whether I want to pay such high valuations for this kind of growth profile, growth / probably declining return profile.
All right, that's about the market action. But on to the second headline now. Reliance gained 1% after the company's 45th AGM took place yesterday. Most brokerages have raised their target prices and, in fact, have target prices higher than the current market price. So let's take a quick look at them. UBS, Jefferies, Goldman Sachs, Citi and CLSA all have a buy. And target prices are anywhere between 2,800 all the way to 3,225. Now, the big takeaway, as we know, is that Reliance Jio will be launching the 5G network, the largest 5G network, by Diwali this year. In fact, there'll be a pan-India 5G coverage by the year 2023, that's next year. And for this, they will make an investment of 2 lakh crores for the complete rollout. Apart from that, the interesting bit was that Reliance will be launching the FMCG business this year, and that will, of course, be under the retail umbrella. They will also be investing 75,000 crores in the oil-to-chemical business over the next 5 years. And all of this will help Reliance Industries double their value by 2027. A couple of other key highlights included the fact that they will be launching JioMart into WhatsApp through the WhatsApp chat interface. They are working with Google to develop a smartphone as well, an affordable 5G smartphone. But most important from a corporate governance point of view is that a succession plan is now firmly in place. Akash Ambani will be leading Jio, Isha Ambani will be leading retail, and Anant Ambani will be heading the new energy vertical. And this succession plan and clarity on the future course of leadership is something that the street took with both hands. Well, that's on Reliance Industries. Of course, standard disclaimer, Reliance Industries is the owner of the channel that you're watching. But the third headline today, Nifty Pharma Index ended over 1% higher. Let's take a look at how the healthcare and pharma space fared in Q1 of FY23. Ekta is here with all the details. Ekta.
Well, yes, Q1 FY23 threw up some interesting trends in the pharma and the healthcare space. While healthcare companies such as hospitals did meet expectations, the India generic company's performance was weak. In fact, Jefferies in their note points out that the largest miss in Q1 FY23 was from pharma companies, primarily on account of US price erosion. The US pressure in the markets combined with factors such as higher raw material costs resulted in margins being weighed down in Q1. Companies such as Lupin, Alembic and Alchem reported some of the lowest margins ever in the quarter gone by. On the other hand, hospitals within the healthcare segment met analyst expectations. Factors such as occupancies normalizing, price hikes, higher surgical and payer mix, international flights resuming resulted in parameters such as the average revenue per occupied bed, hence margins improving. In fact, hospitals on an average saw high single to double digit sales growth and 200 to 350 basis points margin improvement sequentially. So is this dichotomy in the performance expected to continue? For hospitals, analysts point out the outlook is likely to remain healthy due to factors such as occupancies looking to rise going forward, also along with the case mix and the payer profiles improving further. While for generic pharma companies, recovery is possible only in the next 1 to 2 quarters or 1 to 2 quarters away. So is the preference shifting? For some, yes. Jefferies' pecking order now is hospitals, followed by contract drug manufacturing companies, and finally, generic companies. Similarly, a healthcare fund manager says their preference is in all domestic-focused stories, from hospitals and diagnostics to API companies, which could benefit from the China +1 factor. And yes, while US generic companies are likely to continue facing headwinds such as price pressure, input cost inflation to risks from the US FDA's inspections or litigations, the advice from some is not to entirely avoid the play, but to be selective. HSBC, for example, likes pharma companies that, according to them, are moving up the value chain and have near to medium-term drivers. They like stocks such as Cipla due to their pipeline of US launches, and Sun Pharma, which is on improving profitability in their specialty product sales. Lastly, while healthcare companies might be emerging as a preference, it is important to highlight the risks. Diagnostic companies, which are a healthcare play, are seeing stiff competition, which is pulling down margins. An example was Fortis's margins being pulled lower due to their pathology arm in Q1. Similarly, investments in new verticals, for example, Apollo Hospitals, increased their 24/7 investments, leading to EBITDA loss in the division. A strategic investor, a scale-up of the arm will be a key factor to watch going forward.
Okay, thanks for that report card on the pharmaceutical space, Ekta. Meanwhile, Narayana Ridulya told CNBC TV18 that it will look at building and buying more hospitals to add capacity, even as KIMS closed a deal for the Nagpur hospital. Take a look.
Most of the units are our own, except one unit in Kondapur. There also we are planning to shift, as we mentioned before. So the reason is we always believe to have our own so that it will be in a long run, it will give good ROCE and also the good return of investments for everyone. Acquired the last couple of quarters back, Sunshine, and then this is the Nagpur. What will happen in the beginning of any acquisition, we need to add more consultants. It is going to cost for the organization. Definitely there is a growth in the existing, apart from these acquisitions, there is a single digit growth will be there in our KIMS consolidated one, about 3,000 beds. And these beds may not able to contribute in the next 1 or 2 quarters of this financial year. The next year will definitely contribute a reasonable good growth of double digits.
So we definitely have a stated intent that we will be doing some inorganic play, especially in our Bangalore and Calcutta markets. It can be either brownfield or we could do a greenfield option as well, buy land and build. We do want to expand in Bangalore and Calcutta and in some of our, and where our return on capital is higher in terms of other markets, we will make strategic investments. So that is on the cards, but I don't think I'm in a position to share any of the work that is currently happening for obvious reasons. But definitely we have a stated intent that we will expand because we are almost nearing capacity in some of our flagship hospitals. We need more capacity, so we will build as well as we will, look at some inorganic play.
Okay, we'll slip into a quick break on that note, but do stay tuned in. We'll be back in a jiffy with all